Friends, in this video for ithought Advisor, I am going to talk to you on the topic confusion at the market high. When the indices trade at a high, it's very natural for us to think, should I take some money off the table? Should I withdraw a little money from equities? Should I defer fresh investments? Should I wait on the sidelines and watch for some time till the market comes down? We get a lot of thoughts, self-doubt, fear. We start wondering whether we need to do a little bit more to safeguard our money. We want to push our own natural aggression back a bit because we are worried that the markets are trading near the highs. The highs tend to do this to all of us. It gives us a sense of giddiness. Even when you go very high, you get that, right? So that giddiness kind of puts us off balance, makes our decisions a little bit complex, wants us to be doubly careful. All this comes when the market are at a high. But in a long cycle, these intermittent highs don't matter. That's why we see that all your popular personalities are perennially bullish. So they always give you bullish gyan. It's almost the same case with those who come regularly on TV and talk stocks. Every day they tell you that something is good to buy. That on that day something is very attractive. This could be contextual, but you can't ignore the bullishness. This is where I think investors must differentiate between the attractiveness of the index and the relative merits of individual companies. There will always be some sectors which are out of favor, which you can bet upon when the markets are at highs. These are very obvious sectors. It's not difficult to identify them. But if you keep looking at the index and see that it's hitting a new high all the time, you may miss out on these attractive sectors which are being rejected by the market. Even in a bull market, there are opportunities. It's not as if every bull run is secular. In fact, the present bull run can hardly be termed as a secular bull run. It's always been one set of companies which are concentrated and delivering momentum to the index itself. So, an investor must evaluate whether there are any attractive parts in every market context, identify these parts, measure their relative merits vis-a-vis their own peers and other alternate choices, see their historic valuation and compare whether the current valuation is at a discount to the historic valuation, evaluate whether there is a basis to that discount, and then make up your mind on merit of individual investment decisions. So you don't have to decide on the basis of where the index is, you decide at the company level. This is classic bottom-up investing. So when the markets are at all-time high, you can definitely try some classic bottom-up investing very selectively. One thing you must always be conscious of when the markets are hitting new highs, be very careful about what you pay. Don't overpay. Be rigid that you're not going to get anxious to own something and end up overpaying at the top of that company's price cycle. So you need to be very stable. You should not overpay. You should pay what you think is reasonable value. You should give yourself some comebacks if whatever you buy goes down by 10 or 20% when the market corrects. You can take a little longer to make your decisions. You should control your anxiety to invest money quickly before the market goes up further. That anxiety is never going to help you. And you must understand that when you invest near highs, your stocks will also take cues from the market sentiment eventually and lose further value if the markets fall. So you may buy cheap, but cheap can become cheaper and it can become the cheapest also eventually. and this can happen to the best of companies. This is something one should remember when markets are near their highs. Currently, the markets are very close to the highs. Sentiment is buoyant. People want to find new ideas. A lot of ideas are getting thrown around. Ideas which we rejected in the previous bull runs or over the last 2 years are now getting lapped up very aggressively. Institutions are looking for opportunities to create trades which can improve their overall investment and hopefully help them to beat their benchmarks. So everybody is anxious. We must know how to manage that anxiety within ourselves, because that anxiety, if it takes control of our mind, is not going to allow us become better investors in the best of markets. Thank you for watching this video.